Good morning. Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to welcome you to our 2021 Investor Outlook presentation. Today's agenda is very straightforward. First, we will share with you a review of the equity markets for 2020, and then we will discuss the 2021 outlook that we see coming along. Before we begin, I always want to stress the importance to review 5 areas of financial planning. They are preservation planning, retirement planning, tax planning, estate and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's presentation will primarily focus on investment and planning in equity markets. As a quick review, the U.S. stock market ended 2020 at an all-time high. After a waterfall drop and the quickest downward decline of the century in March of 2020, fueled by the largest federal government stimulus ever, historic support from the Federal Reserve and optimism about how quickly the economy is likely to bounce back, the S&P 500 stock index, the most widely watched barometer of the equity markets, finished 2020 up more than 16%. The fact that a pandemic-induced economic shutdown of epic proportions was absorbed by investors and the year ended with stocks at higher level is very historic. In March of 2020, investors saw stocks plummeting 34%, starting a bear market. That bear market turned out to be the shortest downturn in U.S. history. Since the U.S. stock market bottomed on March 23rd, the S&P 500 has risen 68%, shattering all-time records along the way. Clearly, investors who stayed the course were rewarded. I want to be careful here when we talk about this because it was a very narrow market last year. It was mainly in the large tech growth type companies, those companies that did well as people stayed home. Netflix has 200 million subscribers. Think about that for a minute. We see that as we move forward this year. We'll talk more about that. We see this changing. We'll rotate out of it. But the euphoria that's going on and this stuff about Robinhood and the euphoria around that, we're going to talk about that more about that later, probably in a March review. But the euphoria that's going on is very concerning here. And so I've been talking to some of you, some of your kids are getting into that. Please be aware. Please be careful here. I'm reading a lot about Robinhood, and I'm very concerned what I'm reading. While equities climbed higher from their March lows, not all stocks recovered to positive territory, like I was just mentioning. In fact, as you can start analyzing the year-end market highs, gains in Apple, Amazon, Microsoft alone accounted for more than half of the S&P 500's 16% total return for the year. If you remove the top 24 performing companies, dominated by tech and digital services, the S&P 500 return for the other 476 companies would actually be negative in 2020. If you think about the great Warren Buffett and Berkshire Hathaway, if you go back and look at Berkshire Hathaway for 2020 and look at his returns, he did not have the 40 and 50, 60% returns you saw in some of these tech stocks. He was up a little over 2% last year. But let me assure you, that guy has had 20% plus years, year over year. And the reason he's only up 2% last year is what we just talked about, is how narrow this market is. And that's what we're talking about here. It's just a few of the companies like Amazon, Netflix, Microsoft that are moving this market up. So the great Warren Buffett, everybody thinks he's a great investor. If that's the case, then why is he not playing these? He's not playing these because they're very expensive. It's very risky. People are being rewarded for this risk, but they're risky. You're buying these things at highs. Tesla yesterday. Tesla the day before yesterday. 1,228 times earnings, a parabolic curve straight up. That, I wouldn't touch that with a 10-foot pole here. It's just you're buying high, and it's very risky doing that. But people are getting sucked in. They're feeling like they're missing out on things. And so this is what happens. And it's another sign of a market topping too. Interest rates were also not much help for investors in 2020 in terms of money markets and CDs and so forth. They started at 2021 at even more historic lows. Federal Reserve Chairperson Powell announced again at the December meeting and again just yesterday that the interest rates will stay close to zero for the foreseeable future. In fact, he said yesterday, until this pandemic, we see it over with, we're going to keep those low. So definitely through this year, we're going to see low interest rates. Congress also acted last year aggressively, approving $3.5 trillion in emergency relief and stimulus measures in 2020. This was the largest action in the face of recession in U.S. history and provided some of the biggest aid packages in the world. Entering 2021, as this chart shares, interest rates at 0.09% for the average bank money market and 0.16% for the average 12-month certificate of deposit. Both those rates, clearly less than 1%, can be very unattractive to income-seeking investors. This is also one of the reasons when you look at the long rate, the 15 and 30-year mortgages. Last week, I've had people closing on investment properties at a 30-year mortgage at 2.6225%. 15-year rates were at 2.3%. This is the main reason why prices are going higher, because money's cheap. This won't last forever. And in fact, when we see going forward, we'll talk about this in a minute, as we look going forward, we see inflationary pressures coming. But perhaps nothing's been more puzzling than the disconnect between the equity markets and the economy. And the markets, I've told you all a lot, that this is a barometer of the things to come. So what the markets told us all last year was this was going to get better fairly quickly. They bet on a vaccine, it came, and now they're betting on that we get back to this thing quickly. This is pretty normal. It's also a barometer when things are going to get bad. We haven't seen that in a while. The market's rebound reflects Wall Street's optimism about the prospects of 2021, but it also accentuates the disconnect between the stock market's wild success and struggling American households. Wall Street is at all-time highs, but many places are still experiencing shutdowns, high unemployment, overrun hospitals, and economic hardship. Sadly, many local businesses, restaurants, gyms, and small shops may never recover or reopen. Here in Oregon and Washington, they're finally starting to let some of these reopen again. But I think a lot of this stuff's going to be gone. And I think when you look at airlines, cruise ships, the entertainment sector, the energy sector, the things that are going on today out of Washington, all this is going to, the country's gotten lean and mean over the last year. And we see as people get vaccinated coming into this summer, and then getting late in the year and going into next year, we see this pent up demand and people coming at this 20, 30 times. And so we've got leaner industries in those sectors, and we got a lot more demand coming. That's going to be inflationary factors. We see energy prices. If we're cutting down our supply, we see energy prices going up. You're already seeing fuel prices go up. They're up across the country, and they're up right here in the Northwest too. So we'll see more of that. And the way things are going, we could see $5 or $6 a gallon down the road. So all this is inflationary factors that with inflation is rising prices, but it also means that rates will have to eventually start rising as well. And I don't think it's going to take much movement in interest rates going up to slow down this real estate market. Stock market's a different story. We're seeing conflicting data here, where we're seeing a lot of things that we see at the top of the market. IPOs are hot, initial public offerings. That's because there's so many little people uniting to the market. A lot of this through this Robinhood platform, which again, I have a lot of concerns about. But it's also has to do with the amount of money going to, just the easy money. Stocks running, $200 a point, or 200 points in a day. These are the things that we see at a topping of a market. But on the other hand, there's so much money on the sidelines from people that have been concerned all year, and interest rates are ultra low. And this is what I've been telling everybody is markets have come up a lot since the elections. We would not be surprised. We saw it come down pretty strong yesterday. I think it still has some downward pressure to it. Would not be surprised. At some point, we're going to see 10, 15% correction. Even in good markets, we see these 10%, a couple 5% corrections. This is normal. This is healthy. We need these. Markets never go down on good news. But the minute it happens, we think the world's ending. And that is just, these markets just get ahead of themselves. And that's what we're seeing here. And it's the euphoria too, the easy money last year. That millennium generation has never seen a bad time. You and I have. And so that time will come. But I think in the next couple of years, I think we'll see this rotation out of those large growth stocks into more of the value-ended stuff. And so I can see part of the people in the market getting whipped while the other part starts moving forward. So we're in an interesting time. People tell me I contradict myself. I probably do, because we see both these things happen at the same time. But we see is markets correcting here and there and rotation happening. We started already seeing it going into the value stocks. Everywhere you turn, you're reminded that there's a deadly pandemic that's responsible to date for more than 340,000 American deaths and has also left millions jobless and hungry. In fact, as these stats share, as of year end, the COVID-19 daily cases, daily deaths, and hospitalization were peaking to their highest levels. It looks like now things are starting to level off and come back down, and so stuff's starting to open up again. This is a good sign. There's great optimism in the equity markets about how quickly the economy is likely to bounce back in 2021 as the coronavirus vaccines become widely distributed. Investors are focused on the future, and the stock market is priced as a forward-looking indicator. Also, stocks remain appealing for many investors because interest rates are so low, making equities more attractive than other assets such as bonds. It doesn't matter who the president is. Elmer Fudd could have been elected last November. They're not going to stop this economic cycle that we're seeing right now. As people get vaccinated and come back to it, again, that demand's going to be very strong. Delta Airlines 2 days ago came out and said that they're going to hire back 400 pilots by summer. This is all backing up what we're thinking here. People are going to get back to it, and the strength in the economy is coming. In the next couple of years, we see the markets doing very well. If we know inflation's coming, that means higher prices. That's good for equity markets with interest rates ultra low like this. But remember, I'm being very cautious here. This is not a time to chase things that you think you missed. This is not a time to go chase Tesla, Netflix, Amazon. It's time to look, where is the value? Where should we be going? This market's going to get tougher to make money. It's been an easy market. Think about it. We've had 12 years of easy money. This is historic. We see the problems with that. But with that comes inflated assets. And we're seeing that both in real estate and a lot of parts of the market. But there's a lot of the part of the market, and it's that old boring stuff. It reminds me a lot of early 2000, that old boring stuff is where the value is. Your kids aren't going to go there because it's too boring for them. Please don't get caught up in this frenzy. We've seen this many times before. So let's look at 2021. And we'll begin with a new administration in Washington, D.C. I've been telling everybody in our next review meetings in May, we want to really have our ear to the ground. We want to be looking at tax returns this year and next year really hard. We want to be watching changes that could come out of Washington, D.C. and how they might impact us and if we need to adjust things. Our job as financial professionals includes reporting and analyzing political activity and relying on how the new administration could impact the investment world. I go to several meetings throughout the year to find out what's going on in Congress and what could be coming at us. I do this so we can look at these returns and help you. Some of the things that need to be monitored, some specific things that need to be watched include the stimulus. The stimulus concerns me. We're going to do another $2 trillion probably in March. This is easy money. It's great in the short run for markets, but we're going into we have some serious debt. And if you add up, the last number I saw was 27 trillion in debt. And when you take the Forbes top 400 richest people and you took all their money away, but $1 billion for each of them, you're only talking 2.2 trillion. So we need a Congress get serious about this debt as we grow in the next couple, 3 years. We need to be watching the tax increases, tax brackets, different increases. This will affect many of you, not just people 400,000 above. What they're proposing will affect many people. And so we need to be watching this very carefully. Vaccine distribution success. This is a big deal. If the vaccine doesn't come out and continue to be a success, get people to it, then everything I'm saying is going to be mute. This everything, the markets today, everything's going on are betting on a successful vaccine distribution, and they're betting on people getting back to it late in the summer and into the fall. Trade agreements with key international trades like China will be a big deal. So all these things, and what I mean is, whether it's right or wrong, I don't want to get into that, but different things, different policies create different opportunities, and they create things that we should avoid and things that we should go towards. And that's what I'm saying here. That's why we need to be paying attention. Those of you that are euphoric with a new administration, great. Those of you that are very concerned with the administration, I understand, but please don't make poor choices based on that. We need to be watching the policies that are coming out of Washington and how they affect us and where we see the opportunity going forward. At the end of the day, we're not investing in politicians, we're investing in companies. And I'll show you a chart here in a second. Right here, you will see when Democrats, so a lot of investors are wondering, how did Democrats' first 2 years of their presidency, and they have the House of Representatives and then evenly split in Senate, so the Dems have control of the Senate, so to speak, because the vice president can break a tie. While history is nice to look at, it may not be an all-tell sign of the future. However, during 10 previous periods of similar circumstances that date back to 1949, 8 were positive for the 2-year period. For 2021, we'll be carefully monitoring public policy in the new administration. Right now, I think we're going to have a positive next couple of years. But again, we have to be watching the policies that are coming out of Congress and see what happens if that's going to change that. But historically, next couple of years tend to be very good. So what are other analysts forecasting for 2021? The market enters 2021 with favorable outlooks. We've seen it up to this last week. We've seen it very strong. Barron's recently surveyed 10 market strategists and chief investment officers at large banks and money management firms on the outlook for 2021. Averaging their year-end S&P 500 forecast, which range from 3,800 to 4,400, the group expects the index to rise 9% in 2021 to about 4040. Add a dividend yield of around 2%, and their forecasts show the U.S. stocks could return a total of 10% to 11%. The panel also predicts the U.S. economy will grow by 5% in 2021. This will be the fastest pace since 1984. And again, as people come back from this pandemic, a lot of pent-up demand. That would be healthy following a year in which gross domestic product plummeted by 31.4% in the second quarter, as the pandemic gripped the country and soared by 33.1% in the third quarter. While this forecast is optimistic, we'd like to remind you that we consider your feelings about risk in the markets when we review your unique financial situations and make recommendations. As I've been looking at the returns over the year for all you guys, everybody has a different risk appetite. And if you're in a moderate conservative, even a moderate aggressive, you weren't up to 40 and 50%. Some of your funds were, but overall you weren't. And I've said this over and over again. I'm not looking to take it out of the ballpark, especially people in retirement. We just want to see consistency and get our slice out of the middle. There's great optimism about how quickly the economy is likely to bounce back this year as the vaccines become distributed, as we've said. But there's still a lot of uncertainties, and we've talked about them. Risks include the potential damage that can be done if the massive vaccination campaign in the U.S. does not run as smoothly or as quickly. Again, that's why you're seeing them scramble right now to get this going faster. There's still major risk to the economic outlook if the recovery is delayed and corporate revenues and profits fall short of expectations. It will be an interesting year, and our goal will be to continue to communicate with you on how things are proceeding. We see the first part of the year continuing to do these things. I really hope we can get back to face-to-face meetings and face-to-face events like we've had. I think they're really important. We get a lot of information every day. I go to several meetings. I have several sources. There's a lot of things going in my head, and it's good to bring it out there so you see what we see and why we're doing what we're doing. So just a quick recap. 2020 was a great year. It was rewarded. Interest rates are at or near all-time lows. There's definitely a disconnect between the economy and the equity market still at the moment. New administration brings new challenges, new things. We have to keep our ear to the ground. And then the effect of COVID-19 is still critical to investors. again, it all is based on getting people vaccinated and getting back to it. Oops. Caution and diligence are critical. Can't stress that enough. You all know that. I've talked to you about it the last several years. It can be a dangerous market. So we just always need to be focusing on you, your goals and your objectives, and again, your risk levels. And please call us with any concerns. I know some of you already have. We've been talking with you. Please be patient with us. Our assistant Anthony has been out on medical leave. Will be for a few more weeks. So we will get back to everybody as fast as we can. It is tax time. And so gotta love the IRS. And legendary portfolio manager Peter Lynch reminds us that you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready and you won't do well in the markets. Please don't try to time the markets here. We want to be smart trying to time it. We tried to do that in my career early on. It just doesn't work. We might as well stay in money markets earning nothing. And again, what can you expect from us? As always, we're going to be reviewing changes for our clients on an ongoing basis, big time. We're going to continue to give you good regular communication, continue to give you more frequent discussions, and you can expect we're going to continuously reviewing the economic, state, estate, and investment issues for our clients. Changes they're proposing out of Congress definitely need to be zeroing in on estate issues again. We'll all be looking at that. We're going to be offering other workshops that focus on tax changes and planning ideas as we go throughout the year too. And so we'll keep you abreast of everything that we see coming. And we really appreciate you as clients. I just can't tell you that enough. Without you, we wouldn't be here. If you have other people that can use this information, please add them to let us know. We'll get them. We'll get their give us their information. We'll set them up so they get this as well. That's true on our newsletters. That we'll continue to send out the newsletters. Again, I don't like to send junk. I try to send things that are pertinent and timely. And if you've got people that we can help, that this will help them, please let us know. Give us their information, and we will get them on our list and our mailing list, both our mailing list and our email list, to get all this stuff out to them. And again, please call us if you have any questions. And thank you for listening to this workshop. We really appreciate. I care about all of you. And remember, our firm clients come first, and your health and well-being is our highest priority. I hope everybody's safe and healthy, and they stay that way throughout the year. And I hope we get back to it. I hope people start planning. One of the things I've been telling, especially retired people that like to travel, I'll be looking at getting those cruises and airlines locked up now for next year, if you can. Because again, we see prices going up. I think prices on airline tickets could go up drastically. So great time to be looking at that. Again, thank you. If you have any questions, please call us.